Hi, everyone. Nathan Jenison here of the Mortgage Architects. And I want to talk about a common theme that I run into a lot, which is people that basically say, hey, listen, I'm going to wait to purchase when interest rates come down. And at first glance, that makes obvious sense. If you stopped a normal person on the street right now and you ask them whether or not now is a good time to buy, more than 80% of them are going to tell you now is a horrible time to buy. Purchase prices are high, interest rates are high. It doesn't make any sense. It would be stupid to buy now. And that's the predominant thing. It's the highest that has actually ever been in the US. What's interesting is the exact opposite of that is actually true. Now, here's the reason why. When there's fewer people shopping, there's less competition. And what happens in the midst of that is you have sellers that put houses on the market, and those houses tend to stay on the market now longer than they used to, especially because the baseline in people's minds is what happened in 2020 and 2021 when people were buying houses sight unseen in less than a day. Now, if your house is on the market for a month and a half, you're really nervous about whether or not you're going to be able to sell your house. And so we're seeing more list price reductions where people are lowering the cost of the house to try to get more interest. When a house has been on the market for a while, you have a seller that is much more willing to negotiate. That means they're willing to sell the house for less than the list price. They're willing to potentially give you seller concessions. Seller concessions means that they give you, let's say, $10,000 towards closing costs. That means you are saving $10,000 in terms of the amount of money you need to spend to get into that property. That's huge. If you save $5,000, $10,000 on the purchase price of the property, that's also huge. Now, what is different between now and when there's more people in the market is that if you are in a competing offer situation, that means you're trying to purchase the house while somebody else is also bidding and trying to purchase that house, then you end up in a situation called highest and best. What that means is you have to decide how much you want that house, how much you're willing to spend, and you have to go in at your top dollar and beat that other offer. In that situation, you no longer have a seller that's willing to negotiate. They're wanting the best offer for what's going to line their pockets and their proceeds. In that situation, you're going to spend likely at list price, over list price, and you're not going to get seller concessions for reducing the amount of money you need to bring to closing. That's a lot of money. Most people, when they're thinking of this situation, are thinking of interest rates. That's the big pain point. That's what they're trying to focus on. And it doesn't make sense to have a high purchase price and a high interest rate because you're going to spend a whole lot of money over time. Yes, that is correct. However, the key thing that's being missed here is over time. What period of time are we talking about? The reality is you can save a ton by shopping now on your actual purchase price, and you're not spending that much on interest. Let me show you what that means. If we take a look at the numbers, let's talk about purchasing a $350,000 house now, and let's do it at a high interest rate of 6.5%, which is actually a pretty decent rate for where it is as of this day. We're doing this on a 30-year loan. We're putting a percentage down that is putting us at a minimum 5% down in this situation, and we're coming in with a $2,923 monthly payment. And maybe that's the top end of our range. That feels really uncomfortable. And in the midst of this, let's just say that we're having to bring $22,400 to closing. Now, keep in mind, we might be able to negotiate seller concessions that could lower that, let's say by $5,000 or $10,000. That would be huge. So we're going to take that, and this is essentially where we're going to take as our baseline. Now, if we look at, you know what, 6.5 is too high of a rate. We don't like that rate. We're going to wait a year, and we're going to come in at 5.5. Well, in this situation, that would make sense. It would potentially, we have a 30-year loan. We are lowering that monthly payment by $71.44. All of that is great. We have a problem, however. That purchase price went up to $375. Now, what's happening here is that house is not staying at the same price because we have something called appreciation. Appreciation historically is about 4.5% to 5% nationally year over year. That's ultimately what we expect. In 2024, that appreciation has been over 5%, depending on what part of the year that we've been year over year, even in the worst housing market in over 30 years in terms of real estate purchases. So if we look at this, we have already lost $25,000 of equity by waiting a year. And on top of that, take a look at this, $23,000 versus $22,400. Now, in this situation, the difference is almost $700. Well, that's not that much, and especially considering that we're talking about $25,000 of equity that we lost. But what's interesting about this is what did we save by waiting? Well, we got a 1% less interest rate on a $336,000 loan or $340,000 loan. So, that's significant. Well, we saved $71.44 per month. That's interest savings. If you take the amount of $771.44 and you multiply that by 12, you get $857.28. That means you saved $857.28, but you lost $25,000 of equity. And when you get to the closing on this property, you had to pay an additional $700 of cash to close. Further, you also likely did not get seller concessions because ultimately you're shopping at a much lower interest rate, which is when a lot more people are in the market because there's so many people waiting on the sidelines, waiting for exactly the same thing. So that is a significant loss. And if you were renting during this period, instead of building that equity, guess what? You paid that in rent, which means that that money that you spent in rent is gone, which is going to likely be at least $12,000 that you're adding to this. Now, if we're looking at this in terms of, well, what if we purchase now? And what happens then if you've been in this house for a year? Well, guess what? You can do a refinance, and you're not refinancing the $350,000. You've made some headway. You've been paying down your loan, and so you've already got a little more equity in there. And we're at $336,000. And guess what? Let's talk about a 5.25. Well, why 5.25? Well, the rate right now for purchases, let's say at this point, is a hypothetical 5.5. When you do a refinance, guess what? We can actually leverage it and get you a little bit lower without having to increase the cost on that actual loan. And so we're talking about, let's just say, 0.25% better than the existing rate at that time. Well, if you take a look at that, guess what? That monthly payment now is $2,633, which is saving you $289 a month from where you were. Notice the difference between 71 and 289. So if you wait a year, your monthly payment at that point is $2,851. If you buy now and refinance at that same time, in this hypothetical situation, your payment is $2,633. Which of these scenarios would you rather be in? That's really the situation, is that what's on the surface here, in terms of how people are thinking it, is not well thought through because of the fact that over time, there's a lot of numbers that are changing and dramatically. And it's not ultimately simply about what's going on in terms of interest rates. You got to think about the time factor. Thanks. Talk to you soon.